Archer Daniels Midland Company, stock ticker ADM, is a pretty hot topic for dividend investors right now. We can see over the past year they're down around 29%, and if we look at them year to date, now down over 18%. And just off a quick glance at the dividend metrics, if we come up here and plug in ADM, it looks like there's a lot to like. Look, pretty decent starting dividend yield, sitting at about 3.4%. We can see nice low payout ratios, a history of dividend growth, and a 10 and 5-year dividend CAGR of both around 7 to 8%. So they check a lot of boxes when it comes to the dividend metrics, and also keep in mind that this company is a dividend king. They have over 50 consecutive years of dividend increases. So for a company that's a dividend king and is also down around 28% in the past year, you can see why this is a pretty hot topic. And in this video, we're going to be taking a deep dive into this company and seeing if it's a stock we should consider adding to our dividend portfolio and analyzing if it's trading at a good price. Let's go ahead and jump into it. Now, the first thing we need to point out is this company recently released their latest quarter's earnings. If we come down, we can see Q2 non-GAAP earnings per share of $1.03 was missed by around 21 cents. So that was honestly a pretty big miss. And revenue came in at $22.5 billion, which is down 11.7% year over year, and was missed by about $910 million. So overall, not the best earnings report for this company, which has probably helped push the share price down quite a bit in the past year. Now, if you aren't familiar with ADM, this is a company that generates revenue by processing and selling agricultural products. We're currently looking at their investors' presentations, and we can see they have 4 main business segments, different ways that they generate revenue. They have agricultural services, they have crushing, refined products, and other, and then they have Wilmar. And if we jump over to the 17th slide on this investor's presentation, we can kind of see the adjusted operating profit broken out by each of these segments year over year. So for example, we can see in the most recent year, it looks like refined products was their largest business segment, which is interesting because it actually wasn't the year before. Then we can see we have crushing at number 2, we have agricultural services at number 3, and then Wilmar makes up a small portion of their profits. Now, if we jump over to the 39th slide, I want to talk about something for a moment that is actually really interesting and important to understand as an investor, and that's return on invested capital versus the weighted average cost of capital. Now, if you aren't familiar with these terms, that's okay. Again, ROIC, this stands for return on invested capital. It tells us how profitable are the projects that the company is investing into. And then we have WACC, weighted average cost of capital. One of the key concepts you have to understand is if a company's weighted average cost of capital is higher than its return on invested capital, then that company is actually destroying shareholder value. We want to consistently see the return on invested capital higher than the weighted average cost of capital. And what we can see here is this orange line represents the long-term weighted average cost of capital. They need their return on invested capital to be above that orange line in order for the projects they invest into to be profitable. And we'll talk about this more here in just a little bit, but we can see they did go through some periods of time where the WACC was actually below the ROIC. That's not something I like to see. And in fact, if we jump over to the 9th slide, we can actually get some more insights into the capital allocations and their ROIC targets. So if we come down here, we can see the company is targeting a 10% return on invested capital moving forward. We'll have to keep that in mind. We'll come back and talk about this just a little bit later. But then something I also like to always understand as an investor is capital allocation. This tells me, how does a company plan on rewarding me as a shareholder? For example, we can see they're projecting a dividend payout ratio of around 30 to 40%. That means they're going to use 30 to 40% of their capital in order to pay out dividends. We can see they're estimating maybe around $5 billion of share repurchases, but a lot of their capital is going to be reinvested back into the business. We can see capital expenditures will be around 30 to 40% of cash flows. This is important to keep in mind. And then if we jump over finally to the 44th slide, I want to talk about the dividends and share repurchases. I did already point out, yes, they are a dividend king, 50 years of consecutive dividend increases. That is pretty impressive. But here's what we can see. We can also see the share repurchases listed out right here. Now, I personally like share repurchases for multiple reasons. It's usually a sign of a healthy company if a company is buying back a lot of their stock. And it also helps boost all of the per share metrics like earnings per share, revenue per share, or free cash flow per share. But there's something important we can see in this chart here. The dividends paid out are slightly growing every single year. It's very predictable and very stable. Meanwhile, the share repurchases are kind of all over the place. This is one of the things I don't like about share repurchases. Management teams are constantly changing their share repurchase policy. That's not true for dividends. For example, we can see 2018, 2019, 2020, and 2021. This company bought back very few shares. And if we jump back over to our dividend breakdown sheet, we can actually see why this is. Look at 2018 free cash flow, it's negative. 2019 free cash flow, it's negative. 2020 free cash flow is negative. The company simply did not generate the cash returns in order to buy back shares. It was probably everything they could do just to maintain those dividend payouts. So that's an important concept to understand. Now, we've already touched on some of these other dividend metrics: decent dividend growth, good history of dividends, and a nice starting dividend yield and low payout ratios. But I do have to admit, I really hate how unpredictable the free cash flows of this company have been over the past decade. For me, my personal goal is to one day live off dividend income, and in order to be able to do that, I need to buy companies that are constantly increasing the amount they pay out in dividends. And for a company to do that, they have to predictably grow their free cash flow year over year. So yes, this company has maintained and grown their dividend payments over the past decade and for the past 50 years, but I do have some concerns if they can continue to do that long term with how their free cash flow has looked over the past 5, 6, or 7 years. Now, we can dig into some of these subjects quite a bit more by jumping over to the stock screener tab. If we come up here and plug in ADM, and all this data will load in. Now, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets, it allows you to automatically import stock financials straight into your spreadsheet. Then you can head over to tickerdata.com at the link in the description. Now, one of the first things I want to point out is if we come over here, we can see the free cash flow yield for this company is actually really high, sitting at 9.31%. And this is a pretty important valuation metric because basically it tells you how much free cash flow are the shares you're buying generating. So for example, the current price of this company is sitting at about $58.91, and free cash flow per share in 2023 was sitting at about $5.48. So you're getting a lot of free cash flow per share for the per share price that you paid, sitting at 9.31%. For example, a lot of quality stocks that trade at a premium typically have a free cash flow yield of around 1 to 3%. So at first glance, it looks like they're trading at a decent valuation. Now, we've already touched on the free cash flow a little bit. Look at the free cash flow per share. Not exactly something that I like to see. Again, it's kind of all over the place. We can see revenue per share has jumped up a little bit more over the past 3 years, and the earnings have climbed a little bit more over the past 3 years as well. And like I pointed out, they also have been buying back shares, going from around 661 million in 2013 to now sitting at about 541 million. But here's what I really want to point out. We're going back to that discussion on return on invested capital. If we come over here, we can see return on invested capital for this company was sitting at about 7.1%. Now, for a lot of companies, the weighted average cost of capital is going to be closer to around 8%. So if that was true for ADM in 2023, this company actually destroyed shareholder value. That's pretty scary. We can see it was quite a bit higher in 2022 at about 13.74%. But for the most part, it really concerns me how often they're having years with very low levels of return on invested capital. Obviously, for a company to be able to continue to grow their dividends, to grow their earnings, they have to reinvest their capital back into profitable projects. And what it looks like right now is a lot of the times this company is struggling to find projects that are profitable to reinvest back into. In my opinion, this is one of the biggest concerns for ADM. If we jump over to the profitability spreadsheet, we can see some good things. For example, 5-year net income CAGR, it's up about 14%. That's really good. 10 years, sitting at about 10%. The 5-year revenue CAGR, sitting at about 7.87%. But here's where I also have some concerns. Look at these profit margins. They're very, very slim. Gross profit ratio in 2023 was sitting at 6.69%. Now, it's not always the end of the world for a company to have low gross profit ratios. For example, Amazon has relatively low gross profit ratios, but it is something to keep in mind. It's not typically something I want to see. We can see that 10-year average gross profit ratio sitting at about 6.25. So the gross profit ratio has increased a little bit over the past decade, but it's still pretty slim. And so when we look at this revenue versus cost of revenue, they're pretty close to each other. Revenue in 2023 was sitting at about 93.9 billion, while cost of revenue was sitting at 87.68 billion. So from what we've seen so far, the dividend metrics do look good, but the gross profit ratios are very slim, and I am not a fan of the return on invested capital. I'm actually pretty concerned about this. Now, we're going to discuss these topics a little bit more, but first, let's go ahead and jump into our valuation to see if it's trading at a good value. If we jump over to our valuation spreadsheet, we'll come up here and plug in ADM, and again, all this data will automatically load in. Now, we can see the beta for this company is sitting at 0.73, so you should see a little less volatility than that of the market. Now, the first valuation we're going to look at is Graham's valuation, and this values a company based on how much the earnings per share is projected to grow. And it also takes into consideration current market conditions by looking at the current yield on AAA corporate bonds. So let's go ahead and zoom in just a little bit more and take a closer look at this. Now, the first thing we want to find is the estimated earnings per share average. Now, if you're wondering where I got this number, I actually just looked at analyst expectations in this scenario, and I did it using the ticker data function. If we use ticker data, come over here, plug in ADM, click on estimated earnings per share average, and type in 2024 and hit enter. You can see we get 5.45. So we're going to go with that number, and it's also in line with what I see over on Seeking Alpha. Now, I'm actually applying a very low growth rate projection for this company, and this is something else I want to talk about. We can see it's pretty low, and if we jump back over to Seeking Alpha and we click on earnings and we look at earnings estimates moving forward. Let's scroll down. We can see a lot of people are actually projecting the earnings to be very stagnant for this company, and in fact, some are even projecting that it will decrease over time. Now, if you're anything like me, you're probably wondering why this is. The company does have a low dividend payout ratio like we saw. They're projecting 30 to 40%, and they're also reinvesting around 30 to 40% of their cash flows into capital expenditures. So if they're reinvesting that much cash flows, then why isn't the company projected to grow even more? And this goes back to what we were talking about just a minute ago. The very low levels of return on invested capital. There's just not a lot of great reinvestment opportunities for this company, unfortunately. And in my opinion, this is one of the largest reasons that we're seeing pretty much no earnings growth projected over the next few years. So again, I might even be generous with this 2% growth rate for the company. And after we apply our current yield on AAA corporate bonds and plug everything into this formula, we come to an intrinsic value of $42.15, which is even lower than the current trading price for this company. Now, the next valuation looks a little bit better, and that's our discounted cash flow analysis. And we're valuing the company based on how much free cash flow the company is projected to produce in the future. So in this scenario, I'm projecting a 0% free cash flow growth rate. I'm saying they're not going to grow their free cash flow anymore for the entirety of the company's lifespan, which I know it's going to fluctuate up and down quite a bit, but it's just a projection in this model. After that, we find the present value of these future free cash flows and add them together, add the company's cash and cash equivalents, subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of around $67.20. Now, this is interesting because we're saying even if the company isn't able to grow their free cash flow anymore moving forward, the company's still worth around $67.20 per share. So it looks like they're undervalued according to the DCF model. Now, typically we also look at the multiples valuation, but I didn't really like the comparables for the company in this scenario. So we're going to move forward and look at our dividend discount model. And basically what we're doing is we're valuing the company based on how much they pay out in dividends and how much that dividend is increasing over time. So we can see the last few dividend hikes have actually been pretty decent. There's a low one back in 2021 at about 3%, but then we have 8%, 12.5%, and 11.11%. That's 3 really good dividend hikes in a row, and on average, it's about 8.62% over the last few years. Now, in this model, I'm projecting a dividend growth rate of 4.5% and a discount rate of 8.5%. And based off those numbers, we come to a dividend discount model price per share of $52.25. Now, here's what we have to understand. The dividend growth rate projection is 4.5%, and if we jump over to the dividend breakdown sheet, we can see it's been a little bit higher over the past 10 years, 7.6%, past 5 years, 7.39%. But we have to ask ourselves the question, will these dividend growth rates be sustainable if the company's struggling to grow free cash flow? And the simple answer to that is no. The company's not really projected to grow free cash flow or to grow their earnings. They have low returns on invested capital and the profit margins are pretty slim. So honestly, again, I think I'm being a little bit generous with a dividend growth rate of 4.5%. I think they should be able to sustain a 4.5% dividend growth rate for maybe the next 5 or even 10 years. But unless they find a solution to their return on invested capital problem, the dividend growth rate will eventually go to zero. They just won't have any more capital to continue to increase those dividend payouts. Now, if we jump over to the output tab, we can see with those 3 valuations, we come to an intrinsic value of $53.87, which is actually a little bit below the current trading price. Now, that's interesting because, again, this company is a hot topic in the dividend investing community. It's already down nearly 29% over the past year, and at first glance, it looks like it has great dividend metrics. But for the reasons we've seen today, I actually think this sell-off is somewhat justified. If we come over here and plug in a 10% margin of safety, we come to an acceptable buy price of around $48.48, meaning it's not a good time to consider buying this company. So in my opinion, ADM right now is a great case study. On the surface level, things look really good for this company. It has a low price to earnings valuation, sitting at 11.11. It's down over 28% in the past year, trading close to a 52-week low, and the dividend metrics at first glance look really good. But when you start to dig a little bit deeper, you start to uncover some serious problems for this company. Now, with that being said, that's not to say that ADM's share price can't jump up over the next year. But my real concerns are about the long-term growth prospects of this company. There's simply not many good reinvestment opportunities. Now, I'm not concerned about the company cutting its dividend, or at least not anytime soon. But I think over the next 10 years, we'll see a real slowdown in the company's dividend growth rate, and maybe even 20 years from now, we could see a dividend cut unless something radically changes. But go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling or even adding it to your watch list. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.